Let's get into it. So I've been listening to a lot of podcasts, and I am warming up this podcast and getting it lit up. So I have not found something that I love listening to. I listen to SmartList. I listen to a lot of right-wing media because they are very dynamic. I listen to Ben Shapiro, I guess more right-wing. Listen to NPR, listen to Terry Gross, listen to really everything I can get my hands on. I have not found that one thing that really goes at the pace that I like to go at. I'm high processing. I like a lot of information quickly. Give me something to think about. Get me in, get me out. So I'm going to warm this up. Hey, in the next couple episodes, this is what we're going to get into. We're going to get into the Frank deal. You might not be familiar with the Frank deal. It is a company that JP Morgan bought for $200 million, and the company completely hoodwinked JP Morgan in paying that. They didn't have what JP Morgan thought. So something was sold to the smartest, best, largest bank in the world that was completely fake for a couple $100 million. Right? So we're going to get into how that happened, how to avoid it if you're on the buy side, and how to do, copy the legal things they did if you are on the sell side. We're going to get into Serio, which is a typical Silicon Valley company that came up with a terrible solution and then spent tons of investors' money, wasted it, and came up with a non-solution for a non-problem, and how to not fall into that same step. They made a juice machine, basically. Didn't make anything, and they lost investors' money. All right, and then the next episode we're going to get into is how stadium seating, first theater companies introduced stadium seating, how it wiped out the entire theater industry and just reprogrammed everything, an entire industry, and what you should be working on to reprogram your own industry, wipe everybody out. So that is some of the episodes we have coming up. Quick thing that happened to me coming in here, every day, as you guys know, I'm building a factory in Texas. If you didn't know this, you're not reading any of my emails. It's a $215 million investment. I'm well on the way to funding it. Funded a lot of it myself, and some of my colleagues and friends and some of you guys are in on that deal. So every day I come home to my family, and I've raised, we raise capital for that deal every single day. And I ask my son, who's 10, I say, hey, Asher, how much money did you raise today? And he goes, Dad, I didn't raise any money. I was at school. I go, yeah, well, but after school, what did you do? He goes, Dad, I didn't raise any money. I was at hockey practice. So we do this every day. He goes, how much did you raise? And I go, yeah, I raised $1.3 million. He goes, good job, Dad. And we do this every single day. Except for last night, we didn't get a chance to talk because he had hockey practice. So I just went to say goodnight to him. And he said, Dad, how much money did you raise today? I said, Asher, today I just had meetings. I didn't get to really raise anything. And so he's dead tired. He had school all day. He gets off of school, has to go to piano, gets home from piano and goes to hockey practice and comes home. And so he opens one eye and goes, you didn't raise any money today? I'm like, no, I didn't have a chance today. I was just super busy. And so he climbs himself out of bed, walks down the hallway, and he goes to his college money jar. And he opens it up and he takes out $20 and he hands it to me. He goes, Dad, this is for the factory, because this is for the factory for today. So everybody is in on this deal, even the 10-year-old. Very nice. All right, well, look, this is the stories you've been hearing about in the news. NASDAQ is down 1% today. Trucking and freight logistics stocks slipped after J.B. Hunt Transport Services and Knight Swift Transportation provided soft reads on demand pricing with the respective earnings and guidance updates. So trucking companies have been reporting soft reads on what's happening in the economy. High-growth technology companies also not doing great. Microsoft have layoffs. Meta has layoffs. A lot of high-tech layoffs. High-tech growth technology companies tend to perform more poorly during difficult economic times. Rates are high. Inflation is high. We're teetering around a potential, recession or a soft landing, whatever you want to call it. So it only makes sense the NASDAQ would see the greatest pain today, and it was off 1%. If NASDAQ is off 1%, if the trucking companies are off, and then if you look at the bellwethers or the leaders, McDonald's, you look at, dang it, Nate, what's the name? Dave & Buster's. Dave & Buster's, where I guess I don't think we have a local Dave & Buster's here in our area of Southern California, but this is sort of where factory workers and low-income workers end up going, after work. McDonald's, Dave & Buster's, pet stores. So revenue and income down at the bellwether. So trucking companies, McDonald's, Dave & Buster's, pet stores is where the lower bracket of, our economy live. Of course, we have two economies. One part of the economy is doing really well. That's top 20%. The bottom 80% are bifurcated into two different sections. One is the very lower section, pet stores, McDonald's, Dave & Buster's, trucking companies, Walmart segment. So that's all off. So if tech is off, which tends to be the upper segment, and the bottom segment is off. Where is the money? Where's the money in America to be made by you and I? Personally, I think it's in manufacturing. You know, so economies go in cycles. So you have boom, right? Then you have peak, and then you have contraction, and then you have recovery. So obviously we're in contraction right now. If you don't think we're in contraction, you know, come talk to me, or don't talk to me, even better. But so what happens, so the deal you have to pitch and the money you have to raise better be on cycle. Yeah, so of course, if we are in contraction at the bottom of retraction and getting to resurge into recovery, why would you be out pitching a fintech deal, a coin deal, you know, a med tech deal, AI, you know, super AI? Like, I understand AI is hot, but it's hot for OpenAI, who has $12 billion or $20 billion or $30 million or Microsoft. AI is not hot for you in your AI idea that you came up with at Starbucks with your sister's boyfriend. So we are in contraction. What is hot in a contraction prior to recovery is manufacturing. So let's talk about made in America. Made in America. The majority of these big dollar factory plans that you're hearing about are concentrated in two industries: electric vehicles and batteries, and semiconductors. There have been a few outright cancellations. Construction timelines for these big projects are getting vaguer amid the slow trickle of U.S. subsidies, labor shortages, inflation, higher interest rates, and shifting market dynamics. So this, by the way, if you go to a bank and you propose to them a large loan or a large equity package, this is what they're going to tell you. Slow trickle in the U.S. Labor shortages, inflation, high interest rates, and markets shifting around dynamically. We're not that comfortable putting out a loan of that size or any loan today in your sector. That's right. So if you want to overcome their objections ahead of time, by the way, why walk straight-faced into those things? You know you're going to hear about labor shortages, right? How are you going to get the labor? That your wage estimates are probably going to be higher than you're expecting. Inflation, how are you going to deal with these high loan values or high inflation? Real estate, high interest rates, and all the markets are shifting very dynamically. Those are the objections you're going to have if you have a loan pack. All right, so the big factories, the TSMC, Taiwan Semiconductor Manufacturing Company, makes all the AI chips. Their $40 billion chip manufacturing build in Arizona, behind schedule. I have a friend who works at Intel. $20 billion Intel Corp facility in Ohio, reportedly behind schedule. Ford Motor Company, General Motor Company, Tesla, rethinking their proposed facilities on electric vehicles. Electric vehicle demand is sputtering. Consumers want cheaper options than these super high-priced $90,000 Rivians. Rivian Automotive last week, stock down to $10, said it's pausing construction on a new $5 billion plant outside of Atlanta. So if construction and manufacturing is hot in the recovery, why are those things sputtering? Because they're big, mega projects. You should not stick your nose in a mega project. What I'm sticking my nose into is a $200 million, not a $5 billion manufacturing plant, not defense, not battery tech, not electric vehicles. I can't handle any of that stuff. I have a small balance sheet. What I can manage is a $250 million factory, $215 million factory that can produce $1 billion of product in Dallas, Texas. Like, that's manageable for me. So here's what I've learned. Pitching this deal, raising money for my company. I'm telling you this. This is your opportunity. First of all, make sure you're on cycle. What is not on cycle today is super high tech. That is why you have so much resistance to your business plan from either a customer standpoint, raising capital standpoint, people listening to you standpoint, and anything, because high tech, crazy tech, super tech is off cycle. We are in contraction. Write that on your forearm with a Sharpie if you have a deal. We are in a contraction cycle, bouncing around. Can't get in the numbers today, but we're bouncing around recessionary territory. Why are you pitching something that only like crazy money goes into? Stop that. I'm not doing it. I'm pitching a factory that builds stuff. Here's what I learned pitching the factory. Pitch is a lost. Where did it get lost? It got lost in the everything bubble. In the everything bubble, you could buy a Michael Jordan baseball card, hold it for a month, and sell it 10% more than you bought it for. There was always a buyer on the other side of whatever it is you bought. I recently met with the CEO of a 30,000 person ad agency. CEO, 30,000 employee ad agency. And I walked her through how I would pitch some of her deals. And she was very rude to me, right? And she said, why is it that you, a nobody, can come in here and know how to pitch our deals better than we can? Like, that makes no sense to me. I'm like, I don't like to think of myself as a nobody. I mean, maybe you're a nobody, CEO of a dumb company. But anyway, so she was frustrated. I could just walk in there and repitch these. She goes, if what you are doing, reframing, repitching, providing narrative on deals that we have, and we're an ad agency, I can tell you this, pitch is a lost art. Because here's what happened in the everything bubble. You could buy a Michael Jordan card, you could buy a Lamborghini, and you could sell it for more than you bought it, or you could come up with a coin, name it anything, go raise money for it, where crypto bros were making millions, and you're working hard, doing whatever it is you're doing in your business, while real estate, is doubling overnight, seemingly, and, people who don't have your intelligence, people who don't have your work ethic, people who are not working as hard as you seem to be doubling their money on random real estate, and meanwhile you're working hard during the everything bubble. And the government is giving away free money. So you have friends who have like trucking companies, with 40 employees, right? And they got $40,000 a month, for 6 months from the government to support those employees. And you're a hardworking, consulting agency, engineering agency, something small, and you got no money, right? It didn't make any sense. But anyway, the everything bubble exploded. Startups got too much attention because the startups became all the media stories, became all the big win stories, and everybody's like, I'm going to do a startup. I'm going to do a startup in crypto, blockchain, AI, e-commerce, real estate finance, CBD. I'm going to mine copper on asteroids. Didn't matter. Anything you could think of could get funded. And it got to the point where you can write a startup pitch, a startup business plan, full pitch, with the AI in 60 minutes. You can write a full pitch in 60 minutes. And then you could go out and maybe you got it funded, maybe you couldn't get it funded. The pitch that I'm doing, which is raising money, right? We're raising $215 million for a factory. And much of that money is either been raised or being raised right now. The pitch that is raising money on cycle in construction for that deal. I have 400 hours and I know what I'm doing in building that pitch. ChatGPT cannot write any of it. Just seems slimy and grimy. Pitch is a lost art form. You need to not use ChatGPT, to not copy somebody else's pitch, not look for a pitch deck online, but sit there and say, what is the narrative that is on the cycle, the macro cycle that we're on right now that makes sense for my deal, my company that I'm writing up? So I can get you started on that. We'll do a lot more of how to do that and see real examples coming up in the next few episodes. But I can tell you this. During the everything bubble, over the last 10 years, venture capital has sort of subsumed the how to write a business story universe. What is your mission? What is your vision, right? What is the problem? What are the features of your solution to the problem? What are the benefits of your solution? And what's the value proposition, and who's your team? That's basically the architecture of how a venture firm wants to be pitched today, how you would pitch private equity, or how you would put a deal together, right? That's the narrative arc. I disagree with that. I just spent 400 hours writing a pitch deck. You guys can see it all over all my other stuff, and it works. And it doesn't follow that architecture at all. The new architecture for how you tell a business story is really simple. Number one, there has been a substantial change in the economics of supply and demand in our industry, such that there is more demand than there is supply because of a technical, regulatory, and economic problem. And that problem has not been solved for months, quarters, and years, which has created a huge pool of pent-up demand for supply. This is why we invest our time, money, and energy for a jaw-dropping solution, and we're dropping that jaw-dropping solution into a market, a multi-billion-dollar market in which there is more demand for our solution than there is supply, and that is why we're funding this project to not look for customers, not do marketing, not innovate and create something new, but to feed the extremely hungry jaws of demand with our jaw-dropping solution, which is tested and proven. And this is for this deal. All I have to do is hit the easy button. Just add money, and we feed demand. That's the whole story. So that's a narrative arc that's working today. All you need to do to add to that is about 400 hours with whatever it is you're working on. Be happy to hear about it in the comments. See if I can help you go a little bit further than that. Okay, this, again, we're back with this podcast. We're really going to light it up and tell those stories, like I said, about how the cinema industry collapsed in under a year, how Frank sold the company to JP Morgan while JP Morgan's eyes were closed. And we're also going to do Juicerio, which is a story I never get tired of talking about, where Silicon Valley made a juice machine that doesn't make juice. All right, wrapping up today, and we'll see you next time.